So Kura Sushi just reported a quarter that honestly it kind of breaks my brain a little bit.
Oh, it completely defies the usual laws of physics for the restaurant industry. I mean, the math should not work.
Right, because you've got foot traffic dropping by over 5%, and at the exact same time, their imported food costs spiked by almost 200 basis points.
Which is a massive hit. New international tariffs kicking in.
Exactly. So we are talking about fewer customers walking through the door and significantly higher costs for the actual food they are serving those customers.
A total squeeze on both ends.
Yeah. And yet somehow their restaurant level profit margins actually went up. Like they expanded to 19.1%. So welcome to this Talk Tickers format of the deep dive.
It's the ultimate corporate financial paradox, really.
It is. And our mission today is super clear, very data forward, and actionable. We are crunching the Q3 2026 earnings call transcript for Kura Sushi, ticker symbol KRUS.
And we're going to translate all that Wall Street jargon, look at the hard numbers, and figure out how management out-innovated a really terrible macro environment.
Right. We're giving you the actionable takeaways, the firm opinions on what this means for retail investors, and we're aiming to hit the most important points fast. Because on the surface, the initial data drop here paints a very conflicting picture.
It really does. The top-line growth looks stellar, but then the underlying unit economics, well, they tell a much more complicated story.
So let's start with that top line. Total sales for Kura in Q3 hit $85.9 million.
Which is solid.
Yeah, a 16% increase from the $74.0 million they posted in the same quarter last year.
And if you're just, glancing at a stock screener, a 16% jump in total revenue for a brick and mortar restaurant chain look incredibly strong.
Oh, definitely. But then you look at the bottom line, the EPS net income came in at $0.4 million, which translates to 3 cents per diluted share. And you compare that to the prior year when they hit 5 cents per share. So revenue is up 16%, but earnings per share dropped by 40%?
Yeah, a significant drop. And my immediate reaction, and probably the reaction of anyone holding the stock, is just skepticism.
Totally. Are they just blindly burning cash to open new locations to artificially pump up that revenue number?
Which is a completely valid concern. I mean, it's usually the first trap retail investors fall into when they analyze high growth restaurant chains.
Right. You see the top line growing and ignore the cost of getting there.
Exactly. You can't look at EPS in a vacuum when a company is in an aggressive expansion phase.
Because building a new restaurant is expensive.
Extremely. You are incurring massive pre-opening costs, you have training costs, and high initial depreciation on all the physical assets.
And that drags down net income in the short term.
Right, even as that new location starts generating millions in top-line revenue. So to figure out if they're actually burning cash or building a healthy empire, we have to look past the aggregate revenue. We have to look at the comparable restaurant sales.
Right, the comps. And for anyone new to this, management defines their comparable base as restaurants that have been open for at least 18 full calendar months.
Which makes sense.
Yeah, it gives a new location a year and a half to, normalize its honeymoon period, establish a steady baseline so you aren't just measuring the hype of a grand opening.
Exactly. It gives you a true picture of existing store health versus just raw growth from opening new doors. So what did the mature restaurants actually do?
Well, the big reveal in the transcript is that comps were slightly negative. They came in at negative 0.4%.
Which is usually the number that triggers a massive sell-off algorithm on Wall Street.
Oh, for sure. A negative comp implies your core product is losing its appeal. People are getting bored.
Right, but the real insight from this transcript, the thing that explains the entire paradox of this quarter, is what happened when management split that negative 0.4% apart.
Because a comparable sales figure is just a blended average, right? It's two completely distinct human behaviors. How many people walked in the door and how much money they spent once they sat down.
Yes, the traffic versus the check size. And the split here is drastic.
It's wild. Guest traffic was down a painful 5.1%. But that drop was almost entirely offset by a 4.7% increase in what they call price and mix.
Meaning people either paid higher prices or they bought higher margin, more expensive items.
Right. So let's isolate that traffic number first. Because losing 5.1% of your customer base in a single quarter is a massive red flag.
It really is.
Yeah.
I mean, if you have a restaurant that usually seats 1,000 people a week, 50 of them just decided not to show up.
That adds up fast, and the analysts on the call were naturally aggressive about this. Jeremy Hamblin from Craig-Hallum pushed management really hard for an explanation on why fewer people showed up.
And the explanation we got from Benjamin Portneys, the senior VP of Investor Relations, it felt, well, almost suspiciously convenient.
Yeah, he pointed to two major macro factors. First, elevated gas prices hitting consumers' wallets. And second, the massive distraction of the World Cup.
Right, keeping people glued to their screens at home.
And I have to push back on this a little bit, because every time a restaurant chain posts a bad traffic quarter, they blame the weather, or they blame a sporting event, or, gas prices.
It's the classic corporate playbook.
Exactly. So is the World Cup really a valid excuse for losing 5% of your customers, or is management just trying to cover up a dying consumer trend?
I mean, it sounds like a generic corporate excuse, I agree. But if you look at the historical data for experiential dining, the World Cup effect is remarkably real.
Really? Just from people watching TV?
Yeah, specifically because of the duration of the tournament and the demographic overlap. The World Cup isn't a 3-hour Super Bowl on a Sunday night.
True, it's a month long.
It's a month-long daily barrage of matches. People completely alter their social routines. They host watch parties at home, or they camp out at sports bars where they can scream into television.
And Kura Sushi is a highly interactive, experiential dining format.
Exactly. You are interacting with a revolving belt. You are inserting plates into the slot to win prizes. It is physically impossible to focus on a soccer match while engaging with a Kura Sushi table.
That's a great point. So for an entire month, they basically lost those highly lucrative group dining occasions.
Right. But the gas prices, Portland leaned heavily on that too, especially regarding their California footprint.
Yeah, because they have a massive concentration of restaurants in California.
And that is arguably the more structural pressure point. When gas prices spike at the pump, particularly in a car-dependent culture like California, it acts as a direct regressive tax on discretionary income.
So if it costs a family an extra $30 to fill up their SUV, that $30 has to come from somewhere in their weekly budget.
Exactly. And the easiest thing to cut is the frequency of casual dining. They still like Kura Sushi, but instead of going twice a month, they go once a month.
And that subtle reduction in frequency across millions of consumers easily manifests as a 5% traffic drop.
Yep, so we have organic traffic getting squeezed by the pump and distracted by the screen.
But organic traffic wasn't their only problem. The CEO, Hajime Uba, highlighted a major operations headache that really dragged down their total revenue potential.
Right, he delivered his prepared remarks in Japanese, with Portland translating. And he brought up development delays.
Which is where the reality of retail expansion clashes with municipal bureaucracy. Uba quantified this very specifically. He said unexpected delays in opening new restaurants cost the company approximately 6 revenue months across the quarter.
6 revenue months, just gone.
Yeah. Todd Brooks, one of the analysts, ballparked that as a couple $1 million of lost top-line revenue, just vanishing into thin air.
And losing 6 revenue months is brutal for unit economics. Because when Kura signs a lease and builds out a restaurant, they're operating on a strict financial timeline.
They model exactly when that store needs to transition from being a capital expenditure into a cash-generating asset.
Right. When that timeline slips, the financial friction is immense. You're paying out, but nothing is coming in.
But the reason for the slip is what fascinated me. It wasn't like a supply chain issue. They weren't waiting on raw materials from Japan.
No, it was entirely driven by hyperlocal municipal red tape, unexpected fire inspections, and permitting delays.
Portland explained they had 3 different locations held up by idiosyncratic fire inspection requirements in new counties they were entering.
And he noted that normally if an inspector finds an issue, you fix it, and you get a reinspection in 2 weeks.
But these specific counties had asks that took 6 weeks to resolve just to get back on the inspector's calendar.
Which exposes a highly specific risk for investors looking at Kura's growth trajectory.
Yeah, as they expand out of their core established markets like Los Angeles or Houston, they are entering secondary markets.
Markets and municipalities that have literally never seen a revolving sushi restaurant before. They don't know how to code it.
Portland actually gave an incredible example of this. They just finished building their 94th restaurant overall, which was located in Charlotte, North Carolina.
Okay.
And the local inspectors in Charlotte demanded a bizarre new third-party inspection specifically for the conveyor belts.
Which, from a corporate perspective, must have been just infuriating.
Portland essentially said just that. He pointed out that they have built 93 of these identical restaurants across the country, and they have never once been asked for a specialized third-party conveyor belt inspection.
But a local official in Charlotte looks at this automated sushi highway snaking through a dining room and decides, we need an outside expert to sign off on this.
It's a slightly comical anecdote, but the financial ramifications are severe. Because while that restaurant sits dark waiting for the conveyor belt inspector to show up, the meter is running.
Kura is paying rent on the property. And far more critically, they are paying their staff.
Exactly. Important to emphasize that exact point. You hire an entire staff to open a restaurant. If the opening gets delayed by a month because of a permit, you cannot just tell 60 newly hired restaurant workers to sit at home unpaid.
Not in this labor market. They will immediately go get a job across the street.
So you are forced to either pay them to essentially do nothing while waiting for the permit, or you let them go and absorb the massive cost of re-recruiting and retraining a whole new team a month later.
It's a lose-lose situation.
Yeah.
So when we look at the aggregate headwinds, the picture is grim. You have gas prices and the World Cup draining your existing foot traffic, while bizarre local permitting delays are choking off your new revenue streams and inflating your pre-opening labor costs.
Which makes the second half of this earnings report absolutely wild. We know they were operating in a hostile environment, yet they somehow printed money.
The margin miracle.
Let's dig into it. And we have to start by looking at their cost of goods sold, or COGS, because the macro environment was attacking them there as well.
Yeah, the transcript shows that COGS jumped to 30.2% of sales, up from 28.3% in the prior year quarter.
That is almost a 200 basis point increase, which is a massive blow to the profitability of any restaurant.
And Uba specifically identified the culprit, tariffs. He noted a direct 200 basis point impact strictly from new tariffs on imported ingredients.
And Kura Sushi's entire brand identity relies on authenticity, right? They are not sourcing generic domestic fish. They are importing high-quality Japanese ingredients to maintain that specific flavor profile.
Exactly. So when international trade policies shift and tariffs hit, those ingredients suddenly become vastly more expensive at the border. There's no way around it.
So in a traditional restaurant model, if you lose 2% of your total revenue to a sudden spike in food costs and your foot traffic is simultaneously dropping by 5%,
the profit margins are going to collapse. It is a mathematical certainty. You just cannot cover the spread.
But Kura's margins didn't collapse. Their adjusted EBITDA, which measures raw cash generation before interest, taxes, and depreciation, it surged by over 20% to $6.6 million.
That's incredible.
And their restaurant-level operating profit margin expanded to 19.1%, up from 18.2% last year. So my question is, how do you absorb a 200 basis point hit on food costs and still expand your margins?
You do it by fundamentally altering your labor model. Management achieved a 250 basis point reduction in labor costs.
Wow.
Yeah, labor fell to 30.6% of sales, down from 33.1% the previous year. They quite literally out-innovated the geopolitical tariff problem by finding massive efficiencies in how they staff their buildings.
And this wasn't just a case of cutting hours and making the remaining staff work twice as hard, right?
No, not at all. When John Tower, an analyst on the call, asked how they were getting so much labor leverage while traffic was negative, Porton pointed directly to technology.
Specifically, two major operational shifts.
Right. The first was the system-wide rollout of a new digital reservation system.
And to understand why this saves so much money, you have to look at the anatomy of a busy restaurant host stand.
Oh, historically, managing a wait list is a chaotic, extremely labor-intensive process.
You need 2 or 3 employees just standing at the door, managing clipboards or basic tablets, handing out physical buzzers, physically searching for guests in a crowded lobby.
And dealing with people who put their name down and then just walked away.
Right, the abandonment rate.
Exactly. Waitlist abandonment destroys table turn efficiency. If a table opens up and the host spends 5 minutes looking for a party that already left, that table sits empty, generating zero revenue.
Which kills your margin. But by fully implementing a sophisticated digital reservation and waitlist system, Kura shifted all that logistical work onto the customer's smartphone.
It's brilliant. The software automatically updates wait times, texts the customer when their table is ready, and instantly cycles to the next party if someone cancels.
So it fundamentally reduces the front of house headcount required to manage the flow of guests, and it keeps the tables turning faster.
But the reservation system is just the front door. The real science fiction element of their labor leverage is happening in the back of the house.
Yes. Porton pointed to the deployment of automated robotic dishwashers as a massive driver of future leverage.
And this is where the revolving sushi model has a unique structural advantage when it comes to automation. Think about the physical reality of a Kura Sushi dining room.
Every single table is pulling dozens of small plates off the conveyor belt.
Exactly. The sheer volume of dirty dishes generated per hour is astronomical compared to a traditional steakhouse or an Italian restaurant.
Right, if I go eat a steak, I use one plate, maybe the salad plate. But if I go to Kura, I might use 15 small plates just by myself to get a full meal.
Right. And in a traditional setting, the human labor required to manually scrape, wash, sort, and restack thousands of tiny plates. It's immense. It is a grueling, high-turnover job.
But by implementing robotic dishwashing systems, machines that use high-pressure water injection and automated sorting, they are slicing away one of the most labor-intensive roles in the entire building.
The machine doesn't call out sick.
Yeah.
It doesn't need a break. And it operates at a consistent speed regardless of how busy the dining room gets.
So you combine smart software managing the front door with heavy robotics managing the back sink, and suddenly you have permanently stripped 250 basis points of labor cost out of your P&L.
It perfectly neutralized the tariff hit on the food costs.
But that label efficiency only explains how they protected their margins, right? It doesn't explain the revenue side of the equation.
Sure.
It doesn't explain why the 95% of customers who did show up decided to spend 4.7% more on their meals.
Yes, the price and mix. And this brings us to what I want to call Kura's pricing moat.
Okay, I have a theory on this. Let's look at pricing elasticity. We know inflation has been battering the restaurant sector. The traditional mom-and-pop sushi restaurants, the high-end spots, they're getting crushed by the same higher fish prices and higher rent that Kura is facing.
Right, everyone is feeling the pinch.
But because those traditional spots don't have robotic dishwashers or massive scale to absorb those costs, they are passing the pain directly to the consumer. The transcript notes that Kura's competitors are aggressively hiking their menu prices, some by close to 20%.
And a 20% price hike on discretionary dining is incredibly steep. It changes the entire value proposition for the consumer.
Exactly. But because Kura has this technological umbrella protecting their margins, they didn't have to follow suit. They only took a 4.5% effective price increase.
Which is practically flat in this inflationary environment.
Right. So my theory is this. Are people spending 4.7% more at Kura just because the baseline prices are 4.5% higher? Or is Kura actually stealing high-end market share from those competitors who hiked prices by 20%?
Are they capturing a completely new tier of consumer?
Yes. Are they actually stealing high-end market share, or is this a temporary illusion?
Well, based on a very specific data point revealed in this call, it is absolutely real market share capture, and management knows it. Yeah. John Paul Wallum, an analyst on the call, specifically asked about this dynamic. He wanted to know if customers were trading down from more expensive restaurants and driving up the mix.
And Porton's answer blew my mind. He said that right now, average check growth is actually faster among non-members of their rewards program than it is among their loyal rewards members.
The random walk-ins are increasing their spending at a faster rate than the die-hard fans.
Which perfectly validates your theory. It highlights a psychological phenomenon we call trade down, trade up.
Walk me through that.
Imagine a diner who usually spends $150 at a premium traditional sushi bar on a Friday night. That restaurant hikes its prices by 20%, pushing the bill to $180.
Okay.
The diner decides that is simply too much. They decide to trade down to Kura Sushi, expecting a cheaper, perhaps slightly lower tier experience just to satisfy their sushi craving.
They walk in expecting a budget meal.
Right. But when they sit down and look at the menu, they realize the baseline pricing is significantly cheaper than their old spot. They feel flush with cash.
So what do?
They trade up within Kura's menu. They say, well, since the plates are only a few dollars, let's order the premium bluefin tuna. Let's get a side of shrimp tempura. Let's order a round of premium Japanese beers.
They came to save money, but because the perceived value is so high, they willingly inflate their own check by ordering high-margin premium items.
Precisely. Kura's pricing moat isn't just a defensive shield against inflation, it is an offensive weapon. By keeping their price increases to 4.5% while the industry takes 20%, they are actively pulling in premium sushi eaters and training them to spend heavily in a revolving format.
Porton flat out stated that the power of this competitive advantage cannot be overstated.
So we have a clear picture of the quarter. They fought off macroeconomic traffic drops and local bureaucratic nightmares by deploying robots, smart software, and a predatory pricing strategy that captured premium market share.
But what does this mean for the future? How does management view the next 12 to 18 months?
This is where we look at their forward guidance. Because guidance is where a management team puts their credibility on the line. And Kura's projections for the rest of fiscal year 2026 and into 2027 are fascinating.
Let's start with the revised full-year targets.
Because of those 6 lost revenue months tied up in fire inspections, management had to trim their top-line revenue expectations slightly.
Yeah, they narrowed the FY26 sales guidance to between $330.5 million and $331.5 million.
Which makes logical sense when your physical stores are trapped in permitting purgatory.
Yeah.
But the truly bullish signal came in the very next sentence.
Despite lowering the top-line revenue projection, management actually raised their restaurant-level operating profit margin target.
They're now projecting approximately 18.5% for the full year.
And from an investment standpoint, raising margin guidance while cutting revenue guidance is the ultimate proof of operating leverage.
It means the underlying machine is running hotter, more efficiently, and more profitably than anyone modeled.
They are extracting more cash out of fewer dollars.
And CEO Hajime Uba noted they are getting dangerously close to their historical 20% long-term margin goal.
He hinted they might hit that benchmark much faster than anticipated.
And crucially, they are not letting the local conveyor belt inspectors slow down their macro strategy. They are still targeting above 20% unit growth, sticking firmly to their goal of opening 16 new restaurants this year.
But the real question analysts had was, how do you keep pushing that margin up toward 20% when inflation is still a factor?
Right, you can't just keep buying more dishwashers. Eventually, you max out the tech leverage. What is the next catalyst?
And that leads us to my absolute favorite part of this entire earnings call. It is a psychological software tweak they are making to their prize machines. Let's break down the Bakura Pawn hack.
Okay, we need to explain the mechanics of the Bakura Pawn system for anyone who hasn't experienced it because it is absolutely central to Kura's unit economics.
Gladly. The Bakura Pawn is the ultimate gamification of eating. Above every single table in a Kura Sushi, there is a digital screen and a little plastic capsule dispenser.
Like a gachapon machine.
Exactly. And every time you finish a plate of sushi, you slide the empty plate into a disposal slot built right into the table. The system digitally counts your plates.
And here is the hook.
When you insert exactly 15 plates, the screen plays a short animated video, and the machine physically drops a plastic capsule containing a small toy or trinket.
It relies on variable ratio reinforcement, similar to a slot machine. It naturally encourages tables to overorder.
Oh, absolutely. If a group has eaten 13 plates and they are getting full, they will inevitably order just 2 more plates purely to trigger the machine and win the game.
It is a brilliant driver of average check size.
It is brilliant. But, as Porton explained on the call, management realized there was a flaw in the physical execution of the system.
What kind of flaw?
They ran extensive consumer studies and discovered that while guests absolutely love the challenge of hitting the 15-plate threshold, a huge percentage of them did not actually care about the physical plastic toy inside the capsule.
Which makes total sense. I mean, if you are a couple on a date or a group of coworkers grabbing lunch, you will play the game for the dopamine hit of winning, but you have no use for a branded plastic keychain.
You end up just leaving it on the table when you pay the check.
And from a corporate finance perspective, that is a disaster.
Right. Kura Sushi just paid real capital to manufacture, ship, and dispense a piece of plastic that the customer assigns zero value to. It is pure sunk cost.
So management devised a ridiculously smart tweak. They are updating the software to introduce a choice. Now, when you hit your 15 plates, the screen will prompt you.
It asks, do you want the physical capsule toy dispensed right now? Or do you want a digital voucher for a free dessert on your next visit?
The behavioral economics behind this decision are staggering. Let's look at the immediate mechanics. First, for every customer who chooses the dessert voucher, Kura instantly eliminates the hard cost of producing and shipping that unwanted plastic toy.
That goes straight to the bottom line as cost savings.
But the deferred liability aspect is where it gets genius.
Exactly. When a customer selects the free dessert, Kura is issuing a digital voucher. In accounting terms, that is a deferred liability.
But look at the psychology of the consumer. They leave feeling like they won something high value. However, to actually redeem that value, they're forced to walk back through Kura's doors a second time.
It is a Trojan horse designed to guarantee repeat foot traffic. The customer's sitting in their car thinking, awesome, I scored a free mochi ice cream.
And Kura Sushi's management is sitting in their office thinking, We just guaranteed your next $70 family dinner check, and our customer acquisition cost was the wholesale price of a scoop of ice cream.
It is a masterful manipulation of customer acquisition cost, or CAC. Porton was highly specific about the financial impact of this.
He told the analysts that once his choice system is fully implemented system-wide, management expects it to generate a 50 basis point margin benefit.
0.5% of total margin expansion, generated entirely by a psychological software prompt that swaps a physical toy for a deferred visit.
I am just in awe of how dialed in this management team is to the microeconomics of their dining rooms. It is one thing to manage supply chains. It is another to perfectly optimize the dopamine loops of your customers.
But they aren't just relying on dessert vouchers to drive traffic.
Yeah.
They have a massive marketing engine behind the brand, which brings us to their IP collaboration pipeline.
Right. Intellectual property collaborations are the lifeblood of Kura's marketing strategy. They partner with massive global third-party brands to completely theme the restaurant experience.
The Bikura Pon toys, the interior decor, the waitstaff uniforms, and even specific menu items are all branded with the partner's IP.
And we know this works. Porton laid out the historical data. He noted that a standard IP collaboration drives a low single-digit bump in comparable sales.
But a marquee IP collaboration partnering with a true cultural juggernaut drives a mid-single-digit bump.
So what is management's plan for fiscal 2027? They are stepping on the gas.
They're scaling up the frequency significantly. They are moving from 7 major IP campaigns this year to 8 campaigns in fiscal 27.
Additionally, they are increasing their food-based limited-time promotions from 9 to 12. They want a constant drumbeat of novelty to give people a reason to come back.
And the specific names they are dropping for these collabs are massive, particularly if you follow the gaming and anime sectors. They noted they just finished a highly successful collaboration with Honkai Star Rail,
which is a globally dominant mobile and PC game.
Then they announced a partnership with Atlus's Persona series. And what is interesting is that management specifically noted they are timing this to ride the hype wave of the recent official announcement for Persona 6.
Fans of that franchise have been waiting a decade for that announcement. Kura is tapping directly into that cultural zeitgeist.
The demographic targeting here is incredibly sharp. The Venn diagram of people who are deeply invested in narrative-heavy Japanese role-playing games and people who are enthusiastic about eating at a gamified Japanese revolving sushi bar is practically a single circle.
They are fishing in a barrel. Following that, in September and October, they are partnering with the Apothecary Diaries, tying directly into the massive release of that anime's new season.
But the absolute crown jewel of their pipeline, the marquee event that analysts were asking about, is what is coming in November and December.
Yes. A massive Nintendo collaboration. They are featuring Yoshi to celebrate the release of a brand new game called Yoshi and some mysterious books, which is launching on the highly anticipated Nintendo Switch 2.
When you secure a Nintendo IP tying into a flagship console launch during the holiday season, you have secured guaranteed foot traffic.
When an analyst asked Porton to try and quantify the expected impact of a Yoshi collaboration, he compared it directly to their previous Kirby collaboration.
The Kirby event was one of the most successful periods in Kura's history. These Nintendo partnerships are the definition of marquee events.
They are engineered to drive that mid-single-digit traffic growth precisely when the company needs to flex its top line.
It is a brilliant, self-feeding ecosystem. Think about the mechanics of how all these strategies overlap.
Okay, let's walk through it.
You take a family whose kids are begging to go to Kura, specifically to get the exclusive Yoshi Switch 2 toys. That family uses the digital reservation system,
which saves the restaurant labor costs at the front door.
They sit down and eat 15 plates of food. When the prize screen pops up, the parents choose the free dessert voucher instead of the plastic toy,
which saves the company manufacturing costs and guarantees the family will come back next month.
Meanwhile, the robotic dishwasher is silently handling all 15 plates in the back, saving labor costs, while the premium pricing mode ensures the parents spent 4.7% more on their beers and high-end tuna than they did last year.
Every single lever is pulling in the exact same direction.
Which brings us to the ultimate question for this Talk Tickers deep dive. Now that we have unpacked the raw numbers, exposed the story behind the headwinds and the margins, and analyzed management's guidance and pipeline, we have to deliver the bottom line.
Are we taking a bullish or bearish stance on Kura Sushi?
Looking at this transcript, dissecting the structural changes management has made, I am taking a firmly bullish stance for the long-term retail investor.
Walk me through the core thesis. Why remain bullish when the headline traffic number was down 5%?
It all comes down to the fundamental investing principle of separating the transitory from the permanent.
Okay.
When you look at the top-line pressures that drag their traffic down this quarter, the World Cup dominating global television screens, the sudden spike in California gas prices draining consumer wallets, the absurd local fire inspector in Charlotte demanding a third-party review of a sushi belt.
These are highly transitory, localized events.
Exactly. They are incredibly painful in the moment, and they make the quarter look messy, but they do not reflect a fundamental flaw or deterioration in Kura's business model.
The World Cup ends. Gas prices inevitably fluctuate. Municipal inspections eventually pass, and the stores open. The headwinds fade.
But the margin improvements they implemented to survive those headwinds, those are permanent. Rolling out water injection robotic dishwashers is a structural, permanent reduction in their back-of-house labor costs.
Implementing a digital reservation and waitlist system permanently changes the front-of-house headcount required to run a shift.
The Bakura Pond dessert voucher hack permanently lowers their rewards program liability while systemically driving repeat visits.
They absorbed a brutal 200 basis point hit from international import tariffs, grew their restaurant-level profit margins to 19.1%, and expanded their adjusted EBITDA by 20%.
All while operating with one hand tied behind their back by negative foot traffic and delayed store openings.
Therefore, the actionable takeaway for you, the listener, is clear. If you hold this stock or you are looking for an entry point in the restaurant sector, do not let a superficial headline about a slightly negative comp or a single quarter traffic drop panic you out of a position.
You have to look under the hood at the engine.
And Kura's underlying engine is getting vastly more powerful and efficient. They are successfully utilizing a massive pricing advantage to act as a vacuum in the market.
They are pulling in premium traditional sushi eaters who are exhausted by 20% menu inflation across the street. And they are actively training those consumers to value the gamified, revolving sushi experience.
That is market share capture that they are highly unlikely to give back even when inflation cools.
We started this deep dive talking about how corporate earnings are supposed to follow a predictable set of rules. Costs go up, traffic goes down, profits are supposed to shrink.
It is the fundamental assumption of financial modeling. But Kura Sushi built an umbrella of operational technology, automated labor, and brilliant pricing psychology that completely protected them from the macro storm.
They defied the math.
They built a more resilient machine. So I want to leave you with a final provocative thought to chew on as you review your portfolio this week.
Okay, let's hear it.
If Kura Sushi is capable of pulling off near record profit margins and expanding their bottom line cash generation by 20% while being aggressively squeezed by international import tariffs, while losing significant foot traffic to the World Cup, and while battling local municipal inspectors delaying their growth.
What exactly is going to happen to their bottom line when the macro environment finally normalizes?
Exactly. When the tariffs ease and all that suppressed organic foot traffic comes flooding back into these newly streamlined, robot-assisted, margin-optimized restaurants.
It is a question that should make any growth investor very, very interested.
It really is. The operating leverage waiting to be unleashed there is staggering. Thank you for joining us for this Talk Tickers deep dive into Kura Sushi. Keep looking past the headlines, keep crunching the underlying mechanics of the businesses you own, and we will see you on the next deep dive.